That is the Economists panel on the topic Economics Beyond CPI and Repo Rates. Health of an economy is judged by multiple parameters. Of late, the amount of attention that CPI and repo rate, two ingredients of monetary policy, have attracted as compared to other parameters has been unprecedented. Can we move beyond this? Will be deliberated today in the ensuing discussion. The session will be moderated by Dr. Soumyakanti Ghosh, Chief Economic Advisor, State Bank of India, and I request him to kindly grace the dais. Dr. Subir Gokaran is the Director of Research at the Brokering Institution India Center. His current research interests include policy options in health, education, and financial inclusion. He has commented regularly on contemporary global and domestic economic issues. Prior to this, he was Deputy Governor of Reserve Bank of India, where he oversaw monetary policy, research, financial markets, communications, and deposit insurance, and represented the RBI at the G20 Deputies Forum. He has been appointed as Member Expenditure Management Commission by the Government of India and also Chairman of a task force that will set up a financial data management center. Our next guest is Dr. Sajid Chenoy, a PhD from Stanford University, in JP Morgan's Chief India Economist. Prior to that, he worked as macroeconomist at the International Monetary Fund in Washington, D.C., and was a senior associate at McKinsey & Company in New York. He served as a member of RBI Expert Committee to revise and strengthen the monetary policy framework that proposed inflation targeting in India, and also serves as a member of the Indian Bank Association's Monetary Policy Group. He has authored several publications on the Indian economy, including co-editing a book on Indian economic reforms, reforming India's external, fiscal, and financial policies, with Dr. N. Kruger. Our next panelist is Shri Ajit Ranade. He is the Chief Economist with the Aditya Birla Group, a multinational business house. His career traverses academic and corporate assignments. Shri Ranade is an alumnus of Indian Institute of Technology, Mumbai, and IIM Ahmedabad. He holds a PhD in economics from Brown University, USA. He has been member of several committees under the Reserve Bank of India, including the Committee on Capital Account Convertibility and the Committee to Review FEMA Procedures. He was a member of the Governing Council of Banking Codes and Supervisory Board of India. Our next panelist is Shri Abhig Barua, presently serving as the Chief Economist in HDFC Bank, has 22 years experience in the financial markets with CRISIL, Merrill Lynch, and ABN AMRO Bank. An alumnus of Delhi School of Economics and University of Maryland, USA, Shri Barua is a member of group of economists interacting with RBI Governor before credit policy, also member of group of economists advising the Finance Minister on exchange rate issues, and consultant at the rank of professor with the Indian Council of Research in International Economic Relations, one of India's leading think tanks. He's a regular columnist in the Business Standard, a leading business daily. And lastly, we have Dr. Prachi, a postgraduate from Delhi School of Economics and PhD from Columbia University, is a special advisor in the Department of Economic Policy and Research at the RBI. Dr. Prachi also served as senior economist in Ministry of Finance and Prime Minister's Economic Advisory Council, besides IMF. Now I'll request Dr. Ghosh to initiate the discussion. Discussion will be for 60 minutes and 50 minutes for question answer session as usual. Thank you.
Thanks, Praveena. I think the last panel is always the most difficult one, because in the sense that to get the crowd attention, and also the fact that whenever there's an economist panel, so there could be several opinions, there could be several agreements, or there could be both. So the point and when we were discussing about the panel, when we were discussing with the chairman that what title we should give, after a lot of deliberation, we thought that the possible title, as the governor and chairman had a discussion in the morning, that is very difficult to go in a discussion without the asset quality for chairman and for the governor also with the rate cut or repo rate status or anything. So we thought, why not a discussion on economics on which is beyond the CPI and the repo rate? And every time you will, you find notes on economics, something like that, you'll find a whole lot of notes discussing about the inflation, the CPI, what could be the ideal one, when we can go for a rate cut. So we thought, yeah, why not move a little beyond this CPI and the reported discussion. So the idea is that deliberate over here some of the issues which are impacting the Indian economy and try to see, whether we can arrive actually at a common ground. And I'd also like to thank all the panelists for gracing this occasion. And being the regulator, I would like to start with you, Prachi. Basically, I think I have been going through your blogs in the last couple of days. I think some of the issues which we have mentioned, I think one of the work which you was doing in the finance ministry was on the demographic dividends. That was also, I think you had worked something on the export-import model, because I understand that one of the results which your model was showing in terms of that after the crisis, the imports typically decline, and the exports generally tend to get onto a same, doesn't decline to that extent. To given this context, and given the fact that you have worked at something also being the regulator, what do you think are the possible, long-term issues which are facing the Indian economy? Yeah.
So thank you very much, Shaumya. I'm absolutely delighted to be here. Since I should start, with the standard disclaimer that, whatever I'll say, my views will be personal and not necessarily the official viewpoint of the RBI. And unfortunately, I will not be able to answer any questions or take any questions on, the current monetary policy. So since I think Shaumya, gave the topic as economics beyond CPI and the repo rate, I thought, why not go far beyond the CPI and the repo rate? So I thought I would talk about, some work which I did when I was at the Ministry of Finance with the then Chief Economic Advisor and our team, where we asked the question, what India needs to do to seize the demographic dividend. So, the standard long, policymakers are usually very much worried about short-term issues. But ultimately, also given Shaumya's topic, short run has to be a bridge to the longer run. And the central longer run question, which I think the Indian economy is facing, is where will good jobs come from? And so on the one hand, there are these, growth optimists who are very confident about India's demographic dividend. So if you look at this picture, basically, you see how, the dependency ratio is falling in India like in many other Asian economies as well. So growth optimists basically think that, you have more people in the productive age group, you have more savings, you have greater income, you have better productivity, and you have higher growth. But on the other hand, there are these pessimists who ask the question that, where will the good jobs come from? And so one way to make progress in answering this question is to ask, what did some of the other Asian economies do when they were in the stages of development? And here, this picture just shows some of the, fast-growing Asian economies. Of course, I'm abstracting from all the issues, current issues in China and looking at it in a longer-term perspective. But basically, this picture just shows that after these economies took off, where are they? And, the dark black line is India, and the dotted red line is China. And these are years from takeoff. For example, you can define the years of takeoff. For example, in the case of India, it's 1991. So basically, it's showing that India has actually kept pace with some of the countries like Indonesia, but China was on a totally different trajectory, and that's what the red dotted line is showing. So of course, the next question is, what did China really do? And and as we know, it was a combination of both high investment and increase in total factor productivity. So if India has to increase its growth rate, it has to increase its investment, but also the intrinsic productivity of the jobs. And this picture, which is based on work done by the Asian Development Bank, is pretty shocking in the sense, if you look at employment shares and productivity in India, you see that maximum employment is actually in least productive sectors. And this is what the blue, little blue line is showing you, that maximum employment is in sectors with very tiny productivity, and there's very little employment in sectors which are highly productive. So China increased total factor productivity basically by moving workers from agriculture to industry and services. Can India really go that way? And here, in order to answer that question, we looked at how labor allocation in India looks like in different sectors and how has that changed over time. And this picture is just showing that if you look at agriculture, India is not, the left panel is just showing share of employment in agriculture in years from takeoff compared to some of the other countries. So if you see, India is not very far from some of the other countries like Indonesia and China in terms of share of its employment in agriculture. Even if you look at share of value added in agriculture, it's very comparable across these countries. What is really shocking, and I want to send a picture you might be aware of, is if you look at share of value added in industry, which is the right panel, where you see India being absolutely static. So share of value added in manufacturing in India has been absolutely static over time. On the left panel, you see share of employment in industry, which has been going up, the black squares, if you see. So the point is that India is adding workers in industry, but it's basically adding them in very low productivity jobs. And that is one of the central issues facing the Indian economy now, that you're creating jobs in industry, but they are not going into productive, high productivity jobs. And interestingly, if you look at services, services is a very different picture, because here you actually see that the share of the services, if you see look at the right panel, services is actually productive in India, but the share of employment of services still remains small. So services is highly productive, but you're not creating jobs. You're not creating enough jobs. On the other hand, manufacturing, you're adding workers in manufacturing, but they're going into very low productive jobs. And this is one of the central issues or the dichotomy facing the Indian economy. And these are some standard, why is business not creating more productive jobs? These are some of the standard reasons we know that, regulations, funding, quality of infrastructure, land, and labor impediments. So let me just focus on the last one, which is labor impediments. And here, this picture is just showing that one of the problems that industry is not creating as much jobs is because a lot of jobs are actually created in the unorganized industry. So these dark black lines are basically the growth of unorganized industry, which you see are very high. So we are, industry is creating jobs, but it's basically unorganized sector jobs which have very small productivity. And this is again, a picture which I find quite shocking. This is the capital to labor ratio for the Indian economy, which is increasing at a very, fast pace. So for a labor-abundant country like India, we are increasingly using capital-intensive techniques. So this is again, one of the big puzzles. Given that we are labor-abundant, we should rather use labor-abundant techniques rather than capital-intensive techniques. So this picture I found pretty shocking that, the capital to labor ratio in India is increasing at a very, very fast rate. So why is industry or manufacturing not creating productive jobs? One reason I mentioned that, a lot of jobs are created in the unorganized sector, and the other thing is, a lot of these jobs are informal. So this picture just shows that 85% of the jobs in India are actually in the informal sector. But interestingly, even in the formal sector, most of the jobs which India creates are actually informal. That is, these are jobs without contracts. So if you actually look at informal jobs, about 95% of the jobs in India are actually informal jobs. So let me just quickly say, what way forward on labor, and a lot of the, work is already going on. For example, in states like Rajasthan, something which one thing which we put forward in the work we did is a three-pronged strategy for labor. One is that existing permanent workers could be grandfathered, and the remaining workers could be encouraged to move into contracts that can be terminated, but at the same time giving some worker protection, including severance pay, unemployment insurance, and the right to reverse unfair dismissal, and at the same time create a minimum safety net for informal workers. I showed you two pictures. One was that, the share of employment in industry is very high, but the share of value added in industry is almost static. That is, industry is not creating productive jobs. Services, on the other hand, is high productivity, but it's not creating as many jobs. So what are the impediments to services? And here some of the impediments are common to manufacturing, like regulation, funding, infrastructure, and labor impediments. But the importance of education and skilling, and in particular need for formal apprenticeships, is one of the constraining factor in the services sector. Of course, work is going on some of these fronts. So let me, I think I've taken a lot of Shaumya's time, but let me just conclude with some key messages. So basically, the key message is that India needs to focus on an agenda of creating productive jobs outside agriculture, which will help reap the demographic dividend and also improve the livelihoods in agriculture. If you move workers from agriculture to industry and services, your capital to labor ratio in agriculture itself will rise, because your labor is going to fall in agriculture, and your capital to labor ratio is going to rise, and that's going to increase productivity in agriculture as well. So the other conclusion is that, the need to examine carefully whether regulations constrain businesses excessively, and if so, to strip excess regulation. And finally, ensuring a minimum safety net for workers. With this, I'll just end and...
Thanks, Prachi, for making the issues, a couple of issues from your discussion. I think, as we have discussed in the course of your discussion, demographic dividend is obviously one of them. There are also issues related to these productivity, and also the fact that we are not producing enough jobs in the manufacturing industry. Now let me pick up one of these issues, and I will there are two ways to look into the demographic dividend. One way, as Dr. Gokaran has been looking into on the health and education side, but the other way, which I will ask Sajid, is that, there could be also some, what I will say, there could be possibly some costs of a demographic dividend, say in terms of a policy. For example, I mean, recently there has been, and this debate has been going on for a long time, that we are making a transition, we have made a transition from a WPI to CPI, and you also have been a part of a committee report of the central bank, the Urjit Patel committee report. Now, my point is that, I mean, given the fact the service sector, CPI actually encompasses the large part of the service sector, I mean, it is given, or it is better to have CPI as a better proxy from WPI. Because WPI is actually controlled a lot by the tradable commodities. But my observation over here is that, and you have also been writing a lot about it, we have been looking at the data. For example, if you look into the CPI, the retail inflation numbers, which is now at historic lows, and if you just do some juxtaposition and take out the impact of the oil prices, the numbers actually tend to go significantly higher. I mean, which you often call in economics terms the core of the core inflation. Without getting into the technicality, my simple point is that, I mean, we are now in a situation where oil prices may actually stay low for a considerable period of time, maybe for the next 1 year or so, maybe for the next 6 months, that we can debate. But don't you think that in a situation of declining oil prices, this may not be a problem, but if oil prices actually starts increasing, then this could pose a major constraint to policy making. And given the fact that, I mean, the reasons which has been given also, that moving from a WPI to CPI is that WPI is more controlled by external factors. So if that is the case, don't you think that if I move on to a situation of high oil prices, maybe someday or the other, then again that debate could again resurface, because the CPI numbers, if I look into it, actually there is a lot of influence from the oil price movement.
Thank you very much, Soumya. I think this is a debate that has resurrected itself on the WPI versus CPI. I'll just keep, you've already alluded to some of these things, but I think it's important to be clear-headed. The WPI does not cover services, and services are 60% of GDP. So it won't make sense for a central bank to focus on an inflation measure that doesn't have services. Secondly, I think you want to look at an inflation measure which in a way tells you something about excess demand or lack thereof in an economy. How much slack is there? And is that showing up in your inflation pressures? WPI may not do that by construction, because it's largely a tradable based index, and excess demand can manifest itself both through higher domestic inflation as well as through the trade balance worsening. So I'll give you an example. 2013, January to June, the WPI fell from 7.5% to 4%. If we only looked at those dynamics, you would say, well, there's slack developing in this economy, I should be cutting interest rates. What actually happened in those 6 months was the trade balance, as we know, was getting progressively worse because this excess demand had spilled over into higher imports. We had the taper tantrum in the month of May. The current account deficit was close to 5% of GDP. And so you'd pick up the wrong signal. Whereas CPI, industrial workers in those 5 or 6 months was stubbornly at 10 or 11%, telling you there wasn't so much slack in this economy. The third thing is, as a policymaker, you want to look at other variables, wages in India. You can in developed markets, you've got forward-looking wage indexation where people, where there's centralized bargaining, and people will talk about, in Germany, for example, where expected inflation is and therefore what wage negotiation should be. In India's case, it's backward-looking. We now almost have by construction that NREGA wages with a lag of 1 year are indexed to the CPI rural laborers. So again, if wages are going to be indexed or to any cost of living measure to the CPI, it won't make sense for us to look at WPI. I think precisely the fact that you're getting this wide fork between WPI core inflation, which is running at minus 2.5%, and CPI core inflation, which, as you rightly pointed out, after you strip away all the oil, is essentially at 5.5%, was between 5.5 and 6, tells you that for the non-tradable sector in India, education, health services, recreational services, there isn't as much slack as the signals we pick up from global commodity prices. So I think for a variety of those reasons, I think every central bank in the world looks at the CPI for that very reason. As to commodity prices, these can go both ways. You have commodity disinflation now, which is also having an impact on the CPI. It may not show up directly in fuel prices, though it is pulling out transportation and fuel. One can argue it's pulling down food prices because transportation is a large component of vegetable price, for example. So I think there will be spillover effects of time in both directions, which will ultimately flow through into CPI. But if your economy is going to have a large non-tradable component, you want to make sure that the inflation index you focus on captures that adequately.
Okay, thank you. I have a question about education, which will come back at a later point. Dr. Gokarn, I think we have been discussing, I mean, at the onset, we had a lot of discussion of demographic dividends. And anywhere, whenever you have topics of economics, this demographic dividend comes through. And I think you have been also writing a lot about this education and healthcare. I mean, the fact that even today, the extent, the numbers which we are talking about from the NSSO survey, in terms of the digitalization, in terms of the access, these numbers today are also shows that there has to be a considerable ground which needs to be covered in the health and education sector in India. I mean, what should be the possible Indian model of universal healthcare system? Should it be modeled on a Western system? Or can we do some sort of a PPP in this area also? Because as we see, I mean, even this has enormous implications on the policy part, because a large segment of this education health comes out of the service sector in the CPI, which is mostly sticky downwards.
So you wanted me to address specifically the question of health?
Yeah.
Okay.
I thought this was going beyond the CPI, but then everything has been referring to
So that's,
yeah, I wonder why.
this is beyond the CPI numbers. We're trying to understand what the numbers are all about.
It doesn't say numbers there. So I interpret it as being anything that didn't cover CPI and repo rate. So that's what I prepared for.
We have not covered repo rate.
Okay, I'm sure it'll come up somewhere. You can ask Prachi whether the repo rate is going to go down in October. So I want to provide a little bit of context to this discussion, and I think the framework that I have been using in discussing health is exactly the term that has been used in the context of banking, and it came up in the governor's session this morning, which is the missing middle. When we look at our health care system, and I wrote a piece recently which looked at dimensions of access and cost, a number of very striking sort of features of this. One is this government clearly is promoting Ayush, the alternative medicines, Ayurveda, Yoga, Siddha, homeopathy, and Unani. And there is a separate, of course, department in I don't know if it's a ministry or a department, the health ministry, as a relatively low-cost and efficient alternative. But the survey, which was done in 2014, so it's not that old, suggests that more than 90% of our what are called spells of ailment, that is the event for which a person is treated, are being met by allopathic treatments. In fact, allopathic treatment is higher in rural areas. The percentage of allopathic treatment is higher in rural areas than in urban areas, not by very much, but it suggests that you do have alternatives emerging in urban areas. I haven't studied the phenomenon, I've just described it. The second issue, which I think is very important, is the difference between public and private. And within public, you're really talking about the difference between what are called sub-health centers and primary health centers and hospitals. And in the private sector, it's doctors and hospitals. More than half of treatment, and this is across all income groups, is in the private sector. And within the private sector, a very substantial portion is in the hospital segment. The third dimension I wanted to highlight is the cost. If you compare the cost, the average cost of treatment, I benchmarked it to the 60th percentile of households on the monthly per capita expenditure. So what it comes out, if you're a rural resident, the average cost of a hospitalization episode will be 3 months worth of your household expenditure. In other words, the average cost of hospitalization will take up 3 months what your household expenditure at the 60th percentile. So this is not even poverty. This is not even the poverty line, which is roughly the 27th or 28th percentile. even households that are not poor and are far from the poverty line can actually be pushed into poverty because of the high cost of healthcare. In the urban areas, it's not much better. It's 2.5 times the monthly household expenditure at the 60th percentile. And this I'm talking average. This is not even extreme, intensive care and so on. So this is really, I think, the huge issue that we have to deal with. Just as with education, the inability to get out of poverty is, to a significant extent, the consequence of inadequate education. For health, even if you got out of poverty, there is a high probability that you will get back into poverty if you suffer a spell of ailment which requires hospitalization. Where does the missing middle come in? The missing middle comes in because we are actually straddling two ends of the spectrum on two dimensions. One is on the institutional dimension, where we have primary health centers and so on, but there's nothing between that and the hospital. So if you're not being looked after, your illness is not or cannot be treated at the primary health center level, you're immediately jumping to a hospital. There is a whole intermediate level of clinics and so on which we should have but don't, and the costs of delivering services in those clinics can be significantly lower than the cost that you incur in a hospital. The second dimension is the human resource. We have an unregulated set of medical service providers, and I think one of the reasons why our Ayush network, which is potentially quite, can contribute, is so underutilized, is because of the lack of regulation, the lack of trust. And we have the MBBS plus doctors, but we don't have the paramedics, what used to be called the RMPs, the registered medical practitioners. They're still being produced, but the numbers are very low and their sort of visibility is extremely low in most situations. So here again, if you have even a minor illness, you end up going to a doctor and the costs naturally go up. So if we are to address the overall issue of health access, bringing down cost, increasing access to at least some minimal quality standard, I think the policy response has to be to try and find ways to populate the middles in both these dimensions. And that, I think, is a combination of the kind of skills and training that the medical system needs to provide, and also a huge emphasis on quality regulation. We have these institutions in place, but their reach and impact, I think, is much less than it should be. And I want to again emphasize the fact that just as the lack of education is also a perpetuator of poverty, the lack of healthcare is a reinforcer of it can push people back from having people who've gotten out of poverty, can push them very easily back into it.
Okay, I have a follow-up question. I'll come back to that later. Dr. Ranade, let me shift gear a little bit. Over here. I think yesterday the Reserve Bank awarded 11 license to 11 payment banks. And also, there has been a lot of success in the terms of the Prime Minister, the Jan Dhan Yojana, and also the insurance schemes. In fact, we recently did a sample study of our SBI accounts, and we found that there has been actually a lot of tractions happening in these accounts already. Although if you compare with the pre-Jan Dhan period and the post-Jan Dhan period, the numbers may be a little bit on the lower side, is coming from a lower base, but there has been actually a lot of transaction. The spending is happening, the people are depositing money over there. Do you think that this is going to change the socio-economic status of the country in some way or the other? Because even if I look into the zero balances, that may have been coming down.
I can't say no to that. It's a rhetoric question. Is it going to change? Of course, yes. But what is the extent of the change? So 15th of August was exactly 12 months from the day we joined launched the JDY. And I believe the record is something like 150, 160 million accounts, of which about 46% have non-zero balance. So it's a sign of the times that we have to keep track of how many accounts. I don't know if the banking world does that. How many bank accounts have non-zero balances? But I must, remind that this was done in mission mode. So it's not something, access to finance, finance and economic growth, this is not a mission mode thing. I don't know whether once the mission is over, whether this momentum will continue. Because it's the same thing with toilets. It's not a mission mode thing that you keep track of how many accounts have been opened and how many toilets have been built. Actually, the important thing is what is going to happen into the accounts and what's going to happen to the toilets. I mean, the usage, I meant. So the broader question is finance and economic development, finance and growth. Does more finance, access to finance cause economic growth? That's a very sort of a big question in economics. And I believe, while there may be some debate, but typically it's seen that finance follows growth. That is, to quote the great Joan Robinson, wherever growth is, finance will follow like a handmaiden. So I don't want to say that finance is lack of access to financial services, whether it's savings or loans, credit, insurance, remittances. These services are very important, and it's not as if the lack of access to this will necessarily constrain growth. So I think economic growth impulses have to come, and whenever economic growth happens, financial services will follow. But there is an important, but still the JDY and these kind of schemes are very important. To just give you one example, I believe the DBT, the direct benefit transfer system, which is used now to transfer the subsidy on the gas cylinders, the LPG, directly into beneficiary accounts. So what is done is that everybody has to pay the market price for the cylinder, and you get the reimbursement in your bank account. So necessarily you have to fill out the documentation so that you can connect your bank account to the gas connection. And if you don't have that, then you don't get a reimbursement. Just the mere fact of doing this. So we are not talking about removing the subsidy. We are just talking about connecting it to a bank account. So the JDY kind of paradigm. I believe what has happened is out of 150 million gas connections, this is roughly the same number, 150, 160, the merely DBT connection has reduced the number of beneficiaries by 30 million, something like 1/5. Why? Because either they were duplicates, fictitious, bogus, or something. So this dedupe in the world of software, they call it deduping. So that, if that is the benefit, that's a great benefit. So that is a kind of a straightforward benefit. On top of it is what you said. Is this JDY thing going to lead to more economic growth? To the extent that there are economic activities, firms, households who are constrained by lack of credit or lack of access to finance, to that extent there will be an incremental growth impulse. For example, the microfinance success, India, I think, is the world's capital of microfinance, and we are kind of a world's laboratory because we have so many different models. I believe there was an estimated demand a few years ago of 50,000 crores. The demand for microfinance services, typically microcredit, is almost 50,000 crores. So this is the kind of credit that are typical, say, a vegetable seller or some small kirana store needs to have working capital locked in. And lack of access to working capital to that extent constrains economic activity and therefore constrains growth. But I still feel that is incremental. Of course, the big story, of course, is human capital. The biggest investment, the kind of investment you need for economic growth, I think, is human capital. So if it is constraining people from accessing human capital or investing in human capital because they don't have money, I'm reminded of Mr. Narayan Murthy, who said that he didn't go to IIT because his family couldn't afford the fees. Even back then. So if there are people like that who have constraints in accessing investment to human capital, and if the JDY scheme is going to help them get credit or financial services to access investment in human capital, to that extent, yes. But I think broadly speaking, economic growth impulses have to come from a wide variety of sources, not just finance. And this will be a handmaiden to that process.
Okay, thank you. I'll come back to you again. Avik, I think being one of the large private sector bank, and in terms of the current conundrum of basically low growth and which has been happening, and we are possibly maybe seeing some green shoots. So do you, and the HDFC, your bank actually has been, the credit growth has been very healthy over the last couple of years, even though the growth sometimes have been on the lower side. So are you seeing any evidence of green shoots happening as of now, or do you still think that there is still some couple of months when you will try to see the traction?
Well, I'm going to be a little careful because I don't want to talk too much about my bank for two reasons. One, my chairman is sitting right there, and Number two, I think also because the bank, our bank, HDFC Bank, is somewhat unrepresentative in the sense that our mix of loans is somewhat different from the sort of the median mix of the banking system. So what have we seen as a bank? We've seen reasonable traction on the retail loan book, could have been better. I think we are a little concerned about the rural piece, but it still hasn't sort of, the rural slowdown or the slowdown in rural wage growth still hasn't hit us. We are essentially a working capital bank. And so there we've seen a reasonable performance, and that sort of showed up our overall credit growth. But you know, let's sort of accept the fact that we have faced a lot of competition from disintermediation. And in the absence of that, I think not only ours, but the system's you know, working capital growth would be substantially better. Where we don't see the kind of traction, at least compared to what we had expected earlier, is certainly long-term demand for long-term funds, or you know, term finance, you know, which was supposed to, or was expected to sort of pick up sometime around the middle of this year. And this has to do with the investment cycle, which is, you know, still doesn't seem to have picked up. Well, on the investment front, I think the story is not entirely dismal. I think it's very patchy, but there are you know, segments where there are signs of improvement over, say, the last couple of years. Roads clearly is an area that seems to be doing well. And there are, you know, unexpected sectors like fertilizers, right, which have remained completely dormant in terms of investment spending for a while, but where, you know, action seems to be coming back because of the new urea policy. You have new plants coming up. And there are, of course, these sunrise sectors, like, I wouldn't really call them sunrise sectors, but sectors that have been sort of resurrected in terms of policy attention, renewable energy, urban infrastructure, and so on. And there are these absolutely sort of sectors that we don't really care about much in the sort of broader scheme of things, but which are actually doing reasonably well. Furniture, for instance. I think that's a segment that's doing brilliantly. And it's partly because we are introducing new retail formats, and also because of the ease of payment, because we have you know, payments to the net, now, you know, all sorts of apps that all of us you know, are promoting very aggressively. Where we are, you know, clearly disappointed is, you know, defense is something that was supposed to, you know, show a lot of promise. We really don't see any visibility there, but that's perhaps the nature of the beast. We won't sort of, there are all sorts of issues about transparency in that sector. But certainly, if you are talking about if by green shoots you mean an across-the-board improvement in, you know, investment activity that would sort of lead the economy forward, which is sort of the model or the template that was being discussed earlier, then we are certainly not seeing enough of the green shoots. But what is a trend, and I'll sort of end with this, a trend that we've been noticing is sort of the gradual acceptance of the fact that you know, investments will not pick up, and acceptance at, you know, at various levels among, you know, bankers, among policymakers, and so on. And I think again we are sort of going back to thinking of you know, short-term, what I would say, you know, short-term, but not really short-term, but I mean fixes that have their costs. And I think there is a lot of discussion now on the next pay commission and the pay hikes, you know, driving a consumption cycle forward in the absence of investments. We all know what the fiscal implications are. I think the RBI might just, you know, start freaking out if you know, all this money goes to the hands of a very large number of households that comprise the central government initially and then the state governments. So there have been these changes in, you know, in perceptions or prognosis of what the driver is going to be. And one major change seems to be that we've moved back from looking at investment as a potential driver, again, to sort of betting on the consumption boom with its associated problems.
So basically, you are looking at some sort of possibly, I mean, some sort of a consumption, boost to consumption, which may actually propel investment at a later point of time.
Well, I see a lot of people talking about it. It's going to happen because, you know, the pay commission is a time-bound thing. whether it will have, whether it will sort of blow itself out by doing a lot of other things that are not sustainable, the fiscal overstretch, possible impact on inflation, and an impact on the cost of funds is a different thing altogether. But of course, for some sectors there will be a bit of a kickstart.
Okay, I'll come back to you, but already there are some numbers on the commission which are floating around. I don't know the veracity of the numbers, but they are already, they are mind-blowing. So now let me come to Sajid, one point which I just wanted to highlight out, mention to you. I think we have discussed demographic dividend in great details and also the debate. One point, I think this was, in the last, if you look into the, just juxtapose the policy statement last time when the RBI made, I think there was a specific reference to the education component. The spending on education has been on the higher side. And if I look into actually Dr. Gokarn's findings, in fact, even in terms of the hospitalization and education, which says that the 68th percentile, a person could actually spend 3 months of household expenditure, or could be 2.5 months in urban areas and 3 months in rural areas. Given the fact that in a country, and as that where it is the education and health are necessities, and don't you think that, and given the amount of weightage which they have in the inflation the inflation basket, don't you believe that this could actually act as a drag on the inflation numbers going forward? Because if I look into the experience of the Western economies, they don't have this problem. They have an aging population, so therefore their spending on these components, sometimes the education components could be on the lower side, and there the causation is on the opposite manner. That will tend to put a downward pressure on the rates. But here, if the expenditure on the education and health are actually inelastic, don't you think that could actually act as a drag? Which, so basically, what I'm trying to say, it's a dividend on one point of view, but maybe it's a curse given that people need to spend a higher amount on health and education, which are necessities in basic in our life.
Thanks, Shami. Good question. I'll just make one quick complimentary comment to what Abhik said before answering your question. I think it's important to separate that the next capex cycle that we may see will not look like the last one we had. And therefore, it's important to understand that the leading indicators that we typically monitor may actually be lagging indicators in the next cycle. I get asked all the time, well, if you're saying that capex is picking up, why isn't steel demand picking up? Why isn't cement demand picking up? Why is credit growth so weak? And I think if you realize the global environment now, that we live in an environment of massive excess, global excess capacity in manufacturing and commodities. Commodity prices are highly depressed. And therefore, any investment cycle that you might see, in my view, will be largely narrowly based public investment led in highways, in railways, potentially in defense. And the demand for steel and cement will be very much lagging indicators. If in fact we can build those 10 or 15,000 kilometers of roads in the next 2 years that the NHAI says is possible, then capacity utilization for cement and steel will pick up, and then you'll have complementary investment by the private sector 2 years down the line. Similarly, I think credit, in my view, will be a lagging indicator. There's been a lot of discussion about why banks are risk averse to growing their asset books, and in fact, you've seen lots of non-bank sources of financing. If you do a flow of funds to the corporate sector last year, you find that almost 60% of that came from corporate bonds and commercial paper, which had experienced far more transmission than lending rates. So I just think we need to be careful that in this new world, in this new paradigm, what are the leading indicators we look at? Cement, steel, credit, the classical leading indicators in the mid-2000s, in my view, will actually be lagging indicators here. With that digression, I think the point you're asking is a more fundamental one, which I think is that in an economy with a young population and a demographic dividend, should we be more tolerant of higher inflation? Right? That's essentially the crux of your question.
Inflation on education.
Or education. And what I'm saying is that I don't think that the inflation target will change. Countries go through demographic changes all the time. That doesn't change the inflation target. I think what will happen is endogenously in the system, the interest rate, the market clearing interest rate, to keep you at potential growth, to keep you below your inflation target will evolve. And I'll just give you one example. If in fact we have this large demographic dividend, it should show up in a sense as the need for less saving. It should show up with much more labor force participation. It should show up in much higher potential output, which, all else being equal, should mean that if your potential output is moved up, for any given inflation target that you have, you need a lower market clearing interest rate. So I think what you're saying is very important, that I think the nature of the consumption basket in the next 20 years, the spending on health, the spending on education, will necessarily pick up. But that just means in this new reality that your market clearing interest rate will change, and you should not be changing your inflation target necessarily. So, and this is true of any shock. If tomorrow there's a shock to technology or to preferences or labor force participation, or I would argue even Jan Dhan Yojana, which brings in more informal financial savings or the formal finance network, that should change the interest rate at which you can get to potential output or inflation rate. I'll just make one final comment. I think there's been a lot of talk about the 6% target, and this is not a science, it's more of an art. But that in India's case, like 2% in the US's case, for example, is driven more by establishing a threshold. That what is the threshold beyond which you rapidly experience welfare losses? What is the threshold above which high inflation becomes uncertain inflation, results in macroeconomic instability, diminishes the prospects for investment, for consumption? So I think those are the drivers of what your inflation target should be. Now people can say, you're subject to the Lucas critique, the regime has changed and therefore the threshold must change, and that's valid criticism. But I think that can't be changing. I think the other endogenous determinants of the system will change as you go through this demographic dividend.
Okay, thanks. Dr. Gokran, a follow-up question on this one. I think your points on healthcare and education in terms of the amount of money which we are spending is inadequate, basically, in the sense that, do you think that in a country there has also been a lot of debate? There have been two schools of thoughts in terms of the typical leftist school of thought saying that the social sector expenditure is being squeezed out. And do you think that in a country we have that fiscal space whereby I can push that education and health expenditure a little beyond what we are doing today?
Well, I wouldn't agree with your characterization of my position that we are spending too much money or too little money. I think we have to get the model right first before we decide what is the appropriate level of spending. As I said, in the healthcare context, if the missing middle is actually causing us to spend resources, whether it's private or public, very inefficiently. So the bang for the buck from our public spending is much lower than it should be. And I'm arguing that if you create the right institutional and the skill mix, that a given amount of public expenditure can actually deliver far better health outcomes. That's the proposition they're making. Similarly, in education, some of the numbers that I extracted from the survey is not so much a spending issue as an access issue. We have a huge dropout rate. We have almost universal enrollment up to class 6, which is 94-95%. Gross is over 100 because lots of kids enroll in 2 schools. But from class 7 onwards, it's down to 65-66%. So 30% drop-off is suggesting a whole range of issues which are preventing kids from graduating from primary to secondary. And if you're talking about demographic dividends and providing jobs to 950 million people by 2030, you're not going to provide jobs to people whose educational qualifications are. This is just not inconceivable given the way the world works now. So getting people to stay in school, ensuring that they finish at least some level of, get some level of certification is of critical importance. How it is to be done, I think, requires, again, we don't have a one-size-fits-all answer. There are a number of experiments that are going on across the country at relatively small scale in terms of the mix of, templated content with teacher delivery using technology, assessments that use technology very intensely. All of these are experiments that we need to be, trying to assess more effectively and scale up wherever possible. So this may require a different kind of approach than we're following now. And I think the 3 or 4 elements that we need to keep in mind or to bring into play. One is regulation is very restrictive. Lots of people who are doing promising things with education are hitting against the regulatory barrier, that they cannot run schools or run educational systems in the way that the government, or they're not doing it in the way the government wants them to, so they're not being given licenses, they're not being allowed to certify. You see from that survey that an enormous number of kids is actually availing of private tuitions. In West Bengal, 71% of children are attending private tuition, are availing of private tuitions. The national average is about 35. You're wondering, what are schools doing that induce 1/3 or more of the kids who are enrolled in school to seek outside help? Obviously, there's some basic issue. There's a misallocation of resources. If you're going to school to be educated and you're spending a large amount of money to supplement that through the private sector, there is an obvious misallocation there. So, realigning education, realigning expenditure, realigning delivery systems, I think is the priority. So to me, the question about whether too much money or too little money is being spent and whether we have fiscal space can only be answered once you have the delivery model right. And I don't think we have it right if you look at the indicators, the outcome indicators that we're looking at. And this doesn't even go into the quality of education. Even Pratham, the most minimalist of attainment tests or surveys, is suggesting that a rising percentage of kids in class 5 cannot even read at class 2 levels. And that's really, I think, a frightening kind of scenario.
So I think that's very heartening, because there has been a lot of discussion on this physical space being not available and so on. Dr. Ranade, if I just shifted gear a little bit, in terms of if I just look into the external sector, if you look into the export growth, which has been the negative zone for the last 8 months. I think the pace of deceleration is currently slowing down a little bit. Last month, there was around 10 to 8% deceleration year on year. And given the fact that the exports have a crucial role in the economic development, do you believe that this is a result of the continuing weak global demand? Because the US economy is supposed to be doing better. We are talking about a Fed rate hike or global overcapacity in these industries. So is there any opportunity we can take it from here? Because in terms of, say, maybe India sourcing from other areas where there is global overcapacity or like that?
Yeah, but very quickly, Soumya, I just wanted to add to what Subir said. So this is an example where the big demand for investment is coming from investment in human capital. So I want to relate it to my JDY point that if 1/3 of the households are spending disproportionate amount of money to send their kids to tuitions, will the JDY scheme give them overdraft facility to pay for their monthly tuitions? So that's the kind of questions you have to ask, because that's the financial inclusion, the needs of the people, but I don't think it's an easy question to answer. So on the external sector, as you know, this 8 or 9 months of continuously negative, almost double-digit growth in exports, double-digit shrinkage in exports, contraction, is something very unprecedented, probably not happened for the last 20 years.
Yes.
And a big part of that is, of course, because of the fact that 20% of our exports are just oil. And oil prices have come down, that is petrol and diesel, and the prices have come down by 50–60%, so naturally it's showing up. There's also the fact that India's exports react much more to global income versus exchange rates. So if global income falls by 10%, our exports drop by 20%. So the elasticity is like twice. Unlike for exchange rates, where the sensitivity is in fact the other way, it's only half. So if global GDP growth rate is relatively slower, it's not surprising that our export performance has responded disproportionately. Third factor is that increasingly the import intensity of our exports is also higher. So the fact that global trade is also somewhat subdued, that's getting reflected. So I think how do we get out of here is that we have to wait for the global economy to recover, because that's the biggest kind of impact. That's our exports seem to respond much with greater elasticity to improvement in global trade. But having said that, we should not give up, because all said and done, compared to China, the share of India's exports in global exports are still, what, 3%? It's really small. So even at this base, we should not, be overly dependent on global income to improve. So even from here, if you go from 3 to 4% or 5%, that's an improvement of 50%. So what do we do? So I think here we have to be, for example, there's a big India-China task force, a core group. Chinese opportunity like IT services, pharma, Japan and China are huge pharma markets, but we have not simply been able to crack open those markets. I think so. If we have recently the Commerce Ministry came out with a new trade policy export regime for next 5 years, and that usually works by using incentives for almost 5,000 different tariff lines. But I think the fiscal space we have given for incentives is not enough, given that the country has just benefited by almost 1% of GDP in terms of the oil dividend, in terms of the subsidy, reduction in subsidies. I think we can divert that, of course, substantially to public spending, but also to some fiscal space to incentivize exports. So there's a variety of things we can do. I think we should not be dismayed by the global prospects, because this slow growth is going to be around for quite some time. The Chinese sort of overhang. We can definitely go from 3% to 4% share of global exports, which will be a pretty big boost to our manufacturing.
Just for your interest, I think if you look into the 2012 and 2015 export numbers, I think 2012 the numbers were around 306 billion, 2015 it has moved to 310 billion. And imports on the other hand have declined from 490 to 447 billion. So I mean in the space of 3 years, because exports have been virtually stagnant for the last couple of years. Obik, I think when you are talking about the external sector, one point, and as Dr. Ranade was pointing out during the India-China task force, if I look at from the opposite point of view, basically the fact that the current the Chinese currency yuan has been devaluated, there has been devaluation, and if you look into the numbers which are there on the BIS website, basically it shows that the Chinese currency may be overvalued by more than 20%, 25% or whatever, maybe if you take 100 as the equilibrium one. In that context, there is a talk going on in certain circles, and there have been some writings by some noted economists is that, and also we had a conversation with the chairman, she also believes, the same thing. Is that a blessing in disguise? Is the one getting devaluation? Because at the end of the day, if the China does well, that is going to be good for all of us.
I guess you do have a point there, although I thought it was being seen essentially as a curse, at least in the short term, because China devaluing would sort of export China's deflation to markets that are trying very hard to fend off deflation. I mean, take Europe or take the US, and so it will sort of push back the reflation process. It would push back prospects of growth picking up. So I think in the near term, yes, it could be seen as a negative. But I think you do have a point. And if you look at, I think, the export patterns of China's neighbors and the Southeast Asia region and the North Asia region as well, most of the countries are sort of plugged into China's supply chain. So they do compete with China on a couple of things, but largely they are still sort of major suppliers to this humongous growth manufacturing engine, juggernaut that China still is. And if China does pick up on the basis of a slightly fairly valued currency, then these economies will certainly ultimately benefit as suppliers to that chain. And if you again sort of go back one step and believe that Asia is the only engine of growth that along with the US will sort of drive the global economy forward, then again, there is some reason to believe that, yes, it is perhaps a blessing in disguise. But there are a whole lot of complexities involved, how the US gets affected in the process, how Europe gets affected in the process. So I don't think we can just jump from one view to the extreme opposite of that view to a completely contrarian view and say that, look, it's actually China's devaluation is great for us. It's, you will have to look through the complexities and figure out where the costs and where the benefits are.
Okay. Thanks a lot. And Prachi, you have any last word to say to add to the discussion?
Let me say a few words about the export issue which you raised. One is, we have to distinguish between value and volume of exports. So in most of the work which we've done, and also I think Sajid has been writing, there's less evidence that the volume of the exports is declining as much as the value. Number two, when you look at high frequency data, actually you see, if you look at the sequential momentum, you see exports picking up slightly. So, one is a longer term picture, but one is also, looking at high frequency data. Then I should also mention, I think Ajit mentioned a very important point about how import intensive are your exports. And we've done some work here, and we've looked at firm level evidence on how firms react to exchange rate movements. And one interesting thing we find is that it really depends on firms in sectors which are very intensive in imported intermediates or not. So that really matters for how your exchange rate affects your exports. So if one of the big issues has been a stronger Indian rupee, and the question is it hurting exports? So what we find is that the answer depends on the type of the sector, depending on how intensive you are in imported intermediates. If I'm a sector which is very intensive in imported intermediates, if the rupee appreciates, then these intermediate inputs get cheaper, and I benefit. So in that case, a stronger rupee does not hurt me much. So it depends on, but if I'm a sector which is very high domestic value added, I don't use much, textiles, or I don't use much imported intermediate inputs. In that case, a stronger rupee does hurt these sectors. So the broader point I'm trying to make is, there are a lot of asymmetries, and there are a lot of heterogeneities, rather than just asking the question, whether it's global demand or whether it's exchange rate. One needs to dig deeper into the data to see, what the data is telling us. With this, I'll just close.
Thanks. Thank you, all of you, for an excellent discussion. Now the floor is open for
Question and answers, and anybody who wants to ask a question, please raise your hand. Mic, please, to the lady.
Hi, good evening. My question is specifically to Sajid. He mentioned the fact that, perhaps the recovery that we are expecting going forward may not come from the classical sectors of cement and steel. We are probably looking at the public sector much more closely. The question is, do we have that kind of fiscal space to engineer that growth? And secondly, while we are on the topic of growth, why do we still talk of a growth recovery? The headline GDP still talks of a 7% growth. Do we still need to recover, and till what level will we call ourselves a recovering economy?
Those are existential questions, so I'll try and be more mundane. I think on the first question, I think that is the $1 million question. I think given the global slack that exists, given the fact that exports are, despite the caveats Prachi mentioned, not performing like they were in the mid-2000s. Remember, it's always important to step back and get some context. We keep referring fondly to the 9% growth in the mid-2000s. What drove that? That was a time when the global economy was growing at above 4%. Right? We plugged into the global engine, and exports were growing at 16 or 17% in real terms for 5 consecutive years. They were the fastest growing sector. We won't have the luxury of that in the next 5 or 6 years. The rural economy, for all the reasons mentioned, is going to struggle because there has been a regime shift in terms of rural transfers, minimum support prices. So this will have to be the old-fashioned Keynesian public investment-led push that hopefully will catalyze private investment. I think in terms of the numbers, if you look at the budgetary numbers, there's not, at the central level, the budgeted space was 0.2 or 0.3% higher for CapEx. I think there are 2 reasons for hope. One is that a significant quantum of transfers was made under the 14th Finance Commission to the states. And the hope is the states will use those extra resources for capital investment. And secondly, the point that Ajit alluded to, that with oil at $45 to $50, and with some of the savings on subsidies from the DBT, 30-40% deduplication savings, that opens up a fair bit of fiscal space, anywhere between 0.2 to 0.5% of GDP. So without violating the fiscal envelope, I think what is possible is a recomposition of expenditures away from subsidies, because we have lower oil prices that bring down fuel subsidies, fertilizer subsidies. You're moving to cash transfers, and that opens up some space for public investment. So that really has to be the hope going forward. And then hopefully, there will be some knock-on impact from the private sector as well.
I think you also have to
It's working, sir.
to recognize that government investment, public investment in infrastructure is not exclusive. It is a core. It can be seen as equity around which private investment can be leveraged. So when we're talking about an investment plan that is in lakhs of crores, not all of it has to come from the public sector. This morning we were listening to the discussion of de-risking infrastructure projects, and I think one way to do that is for the public investment to act as the core equity around which private investment come. So I think the ways of engineering and structuring projects which will allow for a given amount of public investment to be very significantly leveraged without causing too much fiscal stress. It will certainly add to it, but it's not a destructive, necessarily a destructive phenomenon.
I think to Subir's point, there's, if you look at the national NHAI, for example, that's exactly what Subir was saying, that there is now this hybrid annuity model where you crowd in private financing, but you don't sort of burden the private sector with the kind of upstream risks, regulatory, land acquisition, construction, that in a way consume the PPP model. So there are innovative structures where you can use both public and private financing, but for a project in which, for which market externalities or market failures exist, there are positive externalities, and therefore the public sector has to play an important role, whether it's highways, defense, or power.
Let me just point a new number to you. Yeah. The total subsidy budgeted in the first quarter was 24,500 billion. And of that, the total subsidy which has been spent on oil is actually 5 billion. So the 25,000 crores of money actually has been freed up for this, as we have been talking about, this public investment. So basically, oil is, as we all are talking about, oil could be the new gold in the current economy.